Have you ever looked at a profit and loss statement and wondered why depreciation reduces profit even though no money actually leaves the business? Many students think depreciation is just a theoretical concept, but it actually tells a very real financial story. So today, let's break down what depreciation truly means, why businesses record it, and why it affects profit without affecting cash. When a business buys an asset, maybe a machine, a vehicle, a laptop, or even a building, it pays the entire amount upfront. That's the true cash outflow. But once the asset arrives, it doesn't disappear or get consumed instantly. It stays in the business, helping generate revenue for many years. During those years, the asset slowly wears out, becomes outdated, and loses value. Even if we can't physically see this loss happening, it is real. Depreciation is the accounting method used to record that gradual decrease in value every single year. Why depreciation is a real expense? Depreciation is considered a real expense because the business is actually consuming the asset while running its operations. If depreciation is ignored, profits will look artificially high, as if the business is using the asset for free, which is not true. The matching principle. Accounting follows the matching principle, which says that expenses must be recorded in the same period as the revenue they help generate. So instead of treating the full asset cost as an expense in the year of purchase, we spread that cost across the asset's useful life. That spreading of cost is called depreciation. Depreciation is not a cash outflow today. Here's where confusion usually happens: depreciation does not involve paying money right now. When depreciation is recorded at year-end, nobody writes a check, nobody pays a supplier, and no cash leaves the bank. The cash already went out earlier when the asset was purchased. Depreciation is simply a journal entry. It lowers profit and reduces the asset's book value, but it does not reduce cash. Because depreciation decreases net profit but not cash, it is added back to profit in the cash flow statement. This adjustment helps show the true cash position of the business. Example. Imagine buying a machine for 10 lakh rupees and depreciating it over 5 years. Each year, the business records 2 lakh rupees as depreciation. But nobody pays that 2 lakh to anyone. It simply represents the portion of the machine used during that year. Profit decreases, but cash remains untouched. So now we understand that depreciation is a real expense because assets genuinely lose value over time, but it's not a cash outflow since the money was already paid when the asset was purchased. It simply spreads the cost across the asset's useful life and shows the true profitability of a business. If this helped you understand depreciation better, make sure to like, share, and follow for more accounting and finance videos.
Thank you.